Yeah. All right, it's that 1 o'clock hour. I'm gonna
Okay.
go ahead and drop off camera, and then Haley, you can start letting folks in. Hello, everyone. Those that called in. Hello, everyone. Attendees that have joined in. Thank you for joining. We're going to give everyone a couple more minutes. See if we have any more additions. We'll get started here shortly. Well, I'm not seeing any more people flow in. Small crowd, but go ahead and get started. Thank you all for joining. I'd like to introduce our speakers. We have Eric Stark. Eric is chairman of the board at FTR, the industry leader in freight transportation forecasting. He spent his entire career in the freight transportation sector as a leading researcher in the freight model share analysis and forecasting. We also have Joseph Towers, senior analyst of rail with FTR. He began his career at Trinity Industries with primary responsibilities including market research and economic forecasting, and informing the organization on the current and future trends for different commodity groups and their respective rail car types. Thank you, Eric, Joseph, for joining us, and I'll pass it over to you.
Oh, wonderful. Okay. Well, thank you. Thanks for that introduction. So just to kind of lay the stage here, we're Joseph and I are going to turn off our videos. We will start sharing the presentation. We will have about 45 minutes worth of prepared stuff, followed by Q&A. And Jeffrey's going to help with that. So I'm excited about that. So I'm going to shut down the video and we'll just start moving ourselves right along. Okay, so it is such a delight to hang out with all of you. This has been just a crazy time. I mean, the world in some ways is there's a lot going on, and in other ways there's nothing going on. And so we're going to try to dissect a lot of this stuff for you. So before we get too far into this, we actually have our FTR conference coming up in Indianapolis, September 9th to 12th. We are so excited. We have a bunch of great sponsors. The Greenbrier Companies is going to be sponsoring the main sponsorship. I'm losing my brain here, but we're going to be doing a thing at Lucas Oil Stadium on that Tuesday night. And so come on out. It's a great time, but the content is wonderful. We're going to talk about, we have the opportunity to talk about truck equipment and trailers, what's going on within the truck market, what's happening with rail and intermodal freight. And we'll have a full day on rail equipment on September 12th. So feel free to use that code. Oh, Joseph, I love it. They use you. So you can use the code 24FTR Joseph 25 to get your 25% discount if you have not signed up to do that. So, okay, with that, let's keep moving on. I'm going to hit the economy. Just a handful of indicators I think we need to be talking about and thinking about. And then we're going to go and I'll give you just a little bit of an update for trucking, hand it off back to Joseph, who'll do rail and to tab it on the kind of talking the rail intermodal stuff, and then move into the rail equipment space. Okay, well, with that, so everybody saw or at least heard about the payroll numbers that came in this past month. And what we do is we like to look at how many jobs are created in the market. And what we found is that we had somewhere just a little over 100,000 jobs being created last month. So I think the number was 114,000. And that's a fairly lackluster number. And it kind of put the market into a bit of a tailspin. Now, I am not overly concerned about this, but it definitely has some repercussions that we need to think about. The Federal Reserve has been trying to figure out how to keep the market from overheating and dealing with inflation. And so payroll is kind of one of the things that does that. So that then takes us to talking about that inflationary pressure. And when we look at inflationary pressure, there are two things that we are looking at. There are two lines here. The first line is the orange one is services. And services on a year over year basis, this is look at consumer price index from last year compared to this last month. And what we're seeing is we're still seeing fairly strong year over year growth. It has been coming down, but not substantially. At least it's moving in the right direction. Where what we've seen on the good side of the equation, which is that blue line, we are now in negative territory. So we have, and this is the core commodity. This takes out food and energy. And we have seen that coming down. So there's still that disconnect there. Now, the Federal Reserve, their target rate is they want something in that 2, maybe 2.5% range they would be fine with. But it's typically right about 2% where they want the inflation rate of all in to be. We are starting to move there. We're probably getting closer in totality to about 2.5%. So there's a little bit more room to move. The big issue, though, is I think a lot of industry participants, based upon looking at the payroll data and what's been going on, is that there's a thought that the Fed should be reducing interest rates now, or they should have already been doing it because they may be behind the curve. The data we're looking at here suggests that they may not be 100% behind the curve because you still have the stubborn highness there for services. So this is a hotly debated topic that's going on right now, and you're going to continue to hear that over the next several months. The expectation is that the Federal Reserve is going to bring interest rates down starting in their September meeting. So we'll have to keep an eye on that. Let's move on and let's talk about what's happening on the industrial side, because the amount of freight that gets moved in the country is really driven by industrial production and what's happening within that manufacturing sector. You know, over 80% of all freight is really the industrial market. It's not the sexy retail market that a lot of us think about. Well, when we look at the growth within this market, we saw pretty good growth in 21 and 22. That put a lot of upside pressure in there. As we got into 2023, it basically slowed down. We have not seen noticeable growth here. We do expect that there will be some growth here in 2024, but it's going to be less than 1%. And by the time we get to next year, it's going to be about 1.5%. This still is too low relative to what we would normally expect growth to be. Even though we do have a limited industrial sector, we do have some tightening of capacity as we move into 2025 on the transportation front, specifically as it relates to trucking. So while it's not a huge amount of growth, it does have some implications that percolate through the overall market. Let's translate this and talk a little bit about GDP, because that's the one that most everybody pays attention to in some capacity. Well, aside, if you saw, we were just looking at the industrial numbers and they've been very, very weak. But if we look at GDP, and this is looking at all output coming from the US particular market, and we've seen that 2023, 2024, it's going to be right in that 2.5% range. I think some of the expectations for 2024 is that it comes down a little bit more in 2025. Maybe it's closer to 1.5%. So there will be some potential weakening over the next several quarters, but not enough to stop the overall growth here. So this continues to suggest a decent amount of activity within the general marketplace. But how do we take GDP and make sense out of it? And the way that we do that is we look at the goods transport sector. And when we do that, basically we're saying, okay, what components of GDP are goods? So we then add those up. And the other thing that we do is if it's an import, well, we add that in there too. So if it's an imported good, we then add it back into the data. For GDP, you actually subtract it. So that's how that works. So the reason why we add it back in is because for us, that is freight in the system. And we want to understand all of that pressure. Well, what we saw is that basically we saw zero growth in 2023 in the goods transport sector. As we move through this year, we're starting to see noticeable increases in that 2.5% range. And by the time we get to next year, it's going to be closer to 3%. Traditionally, you need to see this number at least at 2% or higher to see freight growth within the system and to see it show in the rail and trucking space. So we start to get that as we move over the next several quarters and into 2025. This is not overly robust, but it is a healthy number as we get going forward. Okay, let's talk a little bit about the transportation sector for just a tad bit. Like I said, I'm going to hit the truck freight segment, and then I'll hand this off to Joseph when we get past that. So, what do we need to look at when we talk about trucking? Well, the first one that we're going to peek at is how many loads are in the system. And when we think about loads, what does this mean from a growth perspective? And so an easy way to look at this is year over year growth from truck loadings. And so there are several ways to measure truck loadings. One is you can look at, or trucking, you can look at tonnage, you could look at ton miles, or you could look at loadings originated. Each one has a different niche of trying to understand the implications. But the easy one is to think about loadings because we can see when something is loaded when it moves. That's ultimately what we're trying to measure. So it already has density adjustments in there. What it doesn't have, though, is it doesn't tell us length of haul. So we have to be a little bit careful when we compare this data to, say, rail data, because you're not always talking apples to apples. But in general, one of the things that we have seen is if we look at the bar, that is the year over year change. And the solid number is history. And we can see that we have started to have an increase over the last 5 months. And so that is a very positive sign. And as we get going out into the latter part of 2024, we continue to see further growth. So on an annual basis, we're going to see about 1.5% in 2024. As we get into 2025, that starts to moderate a little bit on a month over month basis. And so that year over year starts to ease back as we get to the latter part of 2025. But even then, we still end up with a almost 2.5% growth within the particular market on an annual basis, which actually is not bad. That's right in line, just a little bit above its historical norm, which is closer to about 2%. So this will have some implications on capacity. So let's talk a little bit about capacity, because I think it's really important to understand what we're trying to measure here and what the pressure gauge is. So if we look at active truck utilization, well, that is saying, here's how much freight I have in the system, right? We were talking about number of loads, and we say, okay, here's how productive they are at moving these loads. And so it tells us how many trucks are moving a load at any given point in time. Then we can compare that. We can either do one of two things. We can say, we can look at it in totality based upon the number of pieces of equipment, or we can say how many pieces of equipment have a driver associated with them. So we're basically saying, what's the driver pool? And that's what active utilization is looking at, saying how many drivers are sitting in a truck right now saying, pick me, versus actually how many are moving freight at any given point in time. Historically, we have seen that average be about 92%. And so the way to read this is if you're below that average, then there's excess capacity and that rates start to come down. And so that the shipper has the upper hand. But once you start to get above that historical average, then things start to tighten and you start to see an increase in rates. And then the carriers have the upper hand and they can start to dictate a little bit more. What we're seeing is that we have reached the bottom already and we've already started to climb out, and we're getting very close to that historical average. So when you're at that dotted line, the easy way to think about this is that you're kind of at equilibrium, right? Neither the shipper or the carrier have control of the market at any right then. It is a fairly more neutralized type of a market. But as we get into the latter part of this year and in the early part of 2025, we should anticipate that things will start to tighten and that rates will start to pick up. And that's exactly what our forecast is doing. So with that, I've hit my allotted time. Joseph, let me pass this off to you. We'll talk about the intermodal space.
Thank you, Eric. Thank you again to the RSI family for hosting us this quarter. So like Eric said, I am going to be walking us through the latest developments in both rail traffic, and then we're going to dive into some of the equipment markets. The reason we do that is we can look just at equipment and see how things have been moving, but hopefully by understanding how traffic levels have changed and equipment utilization levels have changed, we can get a little bit better context into what's going on in the broader rail ecosystem. So we're going to start off by looking at traffic. We have a different breakout for both intermodal traffic and for carload traffic. And so first we're going to look at intermodal, and intermodal specifically as it relates to intermodal moving by rail. So looking at total intermodal units, this is inclusive of both container traffic and trailer traffic. You can see it's clearly been a very strong year on a year-over-year basis. Year to date, we've actually seen total intermodal units up 8% versus 2023. And a lot of that has to do with the recovery from a really weak 2023. And so there's a few points to make based off of that. You can see that at the beginning of the year, year-over-year growth was very strong, going between 10 and 15%. But as the year has progressed, that number has been moderating, which is exactly what you would expect to see at the late stage of a recovery. And when you're looking at 2024 values, not against 2023, but against the 5-year average, you can see that things are actually right on par with a, quote, typical year in intermodal from a pure volume standpoint. Looking into some of the different types of equipment that's used, we can look at containers first. And containers is what's driving most of this growth because it was a recovery of international imports that has really driven most of the growth so far this year. And so when you go back and forth between what container traffic has done and total intermodal, it's a very close reflection. And so what I said earlier, it really relates to what we've seen with container traffic, which is a very strong start of the year and then continued moderation as we progress through to Q3. And we're expecting this moderation to continue, again, as you would expect, as this recovery period kind of comes to a close and we get back to more sort of normal conditions in a rail traffic environment. Going from containers to trailers. So trailers are a much smaller segment of the intermodal world, but they're important to pay attention to nonetheless. So containers have been having a very difficult year. And a lot of this has to do with the bankruptcy announcement of Yellow Corp this time last year. So you actually don't see it in this graph, but the AAR numbers that were released yesterday actually show the first year-over-year growth that we've seen all of 2024. And it's not by coincidence that it was the end of July of 2023 that Yellow Corp announced their bankruptcy. And so we knew that we would have to stop falling eventually. Eventually, we'd have to get back to a comparable year-over-year comparison. And we didn't have that in quarters 1 and 2, but it looks like we'll have that now going into quarters 3 and 4. And now, so that's what's been going on the intermodal side so far year to date. But now we want to look at what's going to happen as the year progresses and as we get into 2025. So like I had mentioned, total intermodal traffic was up 8% year to date so far in the year. With the belief that these gains are going to continue moderating. We see that 8% going down to a little bit lower of a 6% rate before we get back to a intermodal unit traffic rate similar to what we would see for the trucking environment that Eric went over, of somewhere between 2 and 3%, which is indicative of a pretty normal, pretty stable market moving in line with what we'd expect based on our economic outlook. So that brings us up to date on what's been going on with intermodal traffic. Now we're going to spend a little bit of time on carload traffic, and then we're going to dive into equipment rates. So total carloads, which this is everything except for intermodal, has really been struggling this year. And a lot of that has to do with the poor performance that we've seen in coal. So coal, if you've been paying attention, had a very rough start of the year and a very rough spring. And a lot of that has to do with the incredibly cheap natural gas prices that we saw, which are natural gas is a direct rival to coal production or to coal demand. And so since things bottomed out in April, things have actually, carload traffic has been ticking up as we approach the beginning of Q3. However, when you look at specifically July, just these last few weeks, we saw that traffic sort of dipped back down again, not on so much of a nominal level, but on a year-over-year level. And there's a few things that can be explained away, and there's a few things that we'll need to keep an eye on going forward. Part of it was there were some strange factors that happened in July. We had a midweek July 4th holiday, which tends to be a little bit of a disruptor to a lot of different industries. And then we also had Hurricane Beryl, which really had an impact on the whole Gulf region, particularly Texas, Houston area, and Louisiana. Beyond that, there's also the looming threat of the Canadian rail strike that we could get an announcement on the legality of it as early as tomorrow. So that could be playing a role in why we saw continued weakness through July that lasted beyond just the first 2 weeks of July, like we would have otherwise expected. So going past carloads and looking at something that we call economically sensitive freight, this is a subset of all commodities that excludes your bulk commodities that aren't as vulnerable to economic conditions. So this metric excludes things like coal, grain, and petroleum products. And for most of the year, this has been showing a bit more favorable of a growth environment. Not a great environment, but not as firmly negative as we've seen with the total carload number. But then again, looking at July from a year-over-year perspective, it hasn't been that great of a month. And it's for the same reasons that I just described. And so that's up to the first month of Q3. And then similar to intermodal, we'll talk through what our expectations are for growth as we finish off 2024 and go into 2025. So we're not expecting to see positive growth in overall rail traffic. Coal has been improving over the past few months, but it's still in negative territory. And that, along with different commodities that are also showing negative, it's not enough to offset some of the bright colors that we're seeing in other commodity groups. So our expectation is that total carload traffic will be down 1.7% as we finish off 2024. And then again, similar to intermodal, it's similar to trucking. We're expecting a more normal environment of 2 to 3% growth as we get into 2025 and beyond. Our economically sensitive freight tells a little bit more optimistic story in 2024 of 0%, which isn't growth, but at the very least, it's not negative. And then again, that 2 to 3% growth range is what we're expecting to see as we go from 25 over into 2026. So that's a recap on what's been going on with trucking. That's a recap of what's been going on with intermodal and with carloads. And now we're going to tie this into the latest ARCI report and how the trends have changed for orders, deliveries, and backlogs. Start by talking about utilization rate. So this is a similar metric to what Eric was talking about with trucking, but it's different enough that we should explain what's actually going on here. So depending on where you are in the rail space, utilization can mean a bunch of different things. If you're a lessor, it means what percent of your fleet is currently on a lease. Maybe for some, it's how many cars have moved in the past 60 days. What this is measuring is, of all the North American rail equipment that we have, how much of it would be required to move both historical and expected levels of freight volumes. And so what we've seen is since the end of 2022, it's been hovering right at around 70% that whole time. For the most recent month, we actually saw July figures ticking up a bit, but still it's very stable. You're not seeing that same upward growth in utilization that you saw for trucking between the stable demand for rail traffic and deliveries of rail cars more or less matching replacement demand. We're not seeing any significant evidence to warrant a forecast of utilization rates going significantly up or down. We think that at least over the near term, it's going to stay at that 70% range, which again, we've been seeing over the past 2 years. So looking at a big picture, orders, deliveries, and backlogs from the latest ARCI report, there's a couple things that we need to highlight. So looking first at orders. Orders are very volatile from quarter to quarter and from year to year. And so we're not going to spend too much time on individual quarters of actual order levels. What we're going to do is we're going to spend most of our time on a rolling average. And if anybody has any questions about orders, we can certainly address those during the Q&A session. But in any case, for the past few quarters, we've seen that orders have come in at lower levels than industry deliveries. What this means is that while deliveries have remained stable, the backlog of rail cars has been reducing over the past several quarters now. A point of optimism with it is that when you look at, say, Q2 of 23 to Q1 of 24, that backlog was falling pretty significantly quarter to quarter. With this most recent quarter, it fell a little bit, but it held more or less flat, which is actually a reason why we're still expecting our deliveries outlook to show year-over-year decline for deliveries. But we actually increased our delivery forecast because, in part, we haven't seen backlogs dropping off this quarter from last the way that we have been seeing in recent quarters. So it's encouraging to see that while it fell, it didn't fall significantly like it has been recently. And backlogs, while they have been falling, they're still at a reasonably healthy level. So we like to measure the industry backlog to delivery ratio. And right now it's sitting at 4.2, which is a little bit below what you'd expect to see on a 20-year average back to 2000, which is that 4.9 level. But we still have over 4 quarters worth of deliveries in the backlog, which is to say backlogs are still in a healthy place. So looking specifically at the composition of the backlog, we can see that for a while now, and really now more than ever, it's tank cars and covered hoppers. Oh, not now more than ever, but just as much now, it's covered hoppers and it's tank cars that are making up the majority of the backlog, with, for the most recent quarter, covered hoppers making up 53% of the backlog and tank cars making up about 30%. Some other notable car types are non-intermodal flats, which went from a very small proportion in 2020 to now about 8% of the backlog. And then gondolas, which has been at 5% for the most recent quarter, which is about what it was this time last year as well. So now we're going to do a little bit of a run through of each of the major ARCI car types. We're going to talk through trends that we've been seeing in deliveries and orders. We're going to break out what subcars are doing, and then we're going to open this up to a little bit of a Q&A session. So looking at backlog at boxcars, over the past several quarters, we've been seeing a decrease in both the rolling average of orders and the rolling average of deliveries after they peaked in 2022 into 2023. Looking specifically at what's making up these deliveries, it's no surprise that it's your 60-foot and larger boxcars that, one, have been driving the run-up in deliveries that we saw up to mid-2023. It's also been the reason why we've been seeing a decrease in deliveries. While the 60 and over boxcars, the deliveries have been going down, taking its place are the less than 60-foot boxcars, most notably your 50-foot boxcars. They've actually been taking up a greater share of the backlog over the past year, and a greater nominal number as well. Looking at covered hoppers is one of the ones that has deliveries have continued to ramp up, where a lot of different car types have been normalizing or declining over the past year. We've actually still been seeing a increase in deliveries over the past several quarters for covered hoppers, with demand again being driven by not any single railcar type, but both of them. So we've seen comparable levels of demand for both your medium-sized covered hopper and your large and jumbo-sized covered hoppers falling into that over 5,500 cubic foot car. Lately, it's been your mid-cube cars that have been stable over the past year, where the over 5,500 cars that are moving commodities like certain agriculture products and plastic products, that number has been increasing on both a nominal level and as a share of total deliveries. With the under 3,500, of course, not having much opportunity at all. Open top hoppers have been generally flat, but we've seen that order levels from that rolling average have actually been increasing over the past 2 years, which puts some upward pressure on expected deliveries going forward. So deliveries they've been very volatile, but they've been up over the past year compared to that 2019 to 22 range. And it's no surprise that it's the steel open top hoppers that are driving all of that demand rather than the aluminum, which are typically used for coal service. Going from open top hoppers to gondolas, this is a car type that had deliveries and orders peak back in 2022, and deliveries have been trending lower since then. However, while the average or the rolling average of orders has also been declining, this is one of the cases where we're actually going to want to look at recent orders, not on a rolling average basis, because for several quarters now we've actually seen those orders increasing on a quarter-over-quarter basis, which is another case of positive pressure being added to our outlook for future deliveries of this car type. It's the GB steels that have been driving all the recent demand, and most of it, when you look back over the past couple of years, these are going to include things like your coil cars, which are going to be used, of course, for steel service, where GT aluminum doesn't have any opportunity. That's another coal car. And then GT steel being another car type that doesn't see much demand going forward. Non-intermodal flats has been the car type that has been performing very well from a demand perspective and has continued to perform well. So where a lot of other car types saw a bit of a peak in 2022, these non-intermodal flats have actually been trending up during that same time period on both a orders perspective and a deliveries perspective. And it's not really surprising that most of those deliveries have been driven by the flat cars that are going into automotive service. So rather than your general purpose flat cars or your center partition lumber cars, it's the auto rack service, which is a lot of replacement demand. These are very old cars, has been driving a lot of deliveries, even though organic demand is another opportunity that's been seeing that can be seen for this car type, and by that reasoning, the underlying commodity type as well. And then intermodal flats this is a tricky one. This is a very tricky car type because there are very few buyers. So it's hard to understand exactly what's going on. And it's especially important to have orders coming in at a rolling basis, because when you don't have that, you see a whole lot of these peaks right here where again, a very small number of buyers, most namely TTX, will place a big order, and that creates a little bit of a difficulty when forecasting out, what these numbers are going to be. But looking at historicals, we see that both rolling orders and deliveries have had lots of ups and downs, but generally been trending down, especially from the big picture. And deliveries have been somewhat stable over the past couple of years. Driving the underlying demand for these deliveries are, in the most recent quarter, it was split between your 5-unit platforms and your other platforms. But generally, when we look over the past 2 years, it's your other articulated units, which for the most part, that's going to be 53-foot, 3-unit intermodal cars used for domestic intermodal service. That's been driving these deliveries. And then the last major car type that we will look at is our tank cars. So tank cars is another one. There's been a love-hate relationship with the rail industry because of the wild swings up and down for demand for the underlying commodities. Most significant being rail demand or rail utilization for crude oil service. So you see, these are those big peaks that you see here. One was ethanol, another was crude. I believe this one was based off of crude demand as well. But now, as we look in the past 2 years, both the rolling average of orders and deliveries have both been stable over the past couple of years, with demand really across different car types. So this is another one where it's not one single commodity or one single car type, that has been driving demand, similar to what we saw with our non-intermodal flat cars. But there's demand for both the smaller and the larger non-pressure tank cars, as well as the pressure cars. They all saw orders, or they all saw deliveries for the past several quarters now. And the non-pressure cars have been not too far apart as far as nominal levels of deliveries. Recently, it has been preferencing a little bit of your larger non-pressure cars. These typically tend to be cars that are moving in energy service, though there are some exceptions to that rule. And then similarly, the smaller than 26,000 gallon tank cars, these tend to be more of your chemical fleets, though there are still going to be exceptions. And then pressure cars, of course, being pressurized gases. And so that's a big picture of what's been going on across the different commodity types. Again, as a recap, the orders have been coming in a little bit low over the past few quarters while delivery levels have remained stable. What that means is that over the past year or so, we've been seeing declines in overall backlog levels, but we didn't see that to that great of an extent for the most recent quarters. Backlogs actually held stable, and so that actually led us at FTR to revise our delivery forecast up slightly, even though we're still expecting 2024 to be a lower year than 2023 for total railcar deliveries. And so, with all that said, that's a high level view of what's going on in the economy, what's going on with trucking, with rail traffic, and then the latest ARCI results. Before we turn things back over to Jeffrey for our question and answer session, I will give just one more highlight to the upcoming conference. So again, September 9th through 12th in Indianapolis, we have 2 days dedicated to rail and 1 day dedicated to rail equipment, where we're going to have speakers and panels and really in-depth panel discussions on all manner of rail equipment and rail freight. Sure to use my discount code of 24FTR Joseph 25 to receive 25% off of your registration. And with that, Jeffrey, I will turn it back over to you.
Thank you, Joseph. Just a reminder, if you have any questions, please use the Q&A module at the bottom of your screen. Do have a couple questions for y'all. First one is, what new commodities or material products are flowing through our nation's transportation system that could go through rail if there were rail car designs available?
Joseph, why'd you go for that one, man?
Yeah,
Have
I can
fun.
take that one. So when I look at where the opportunities rest for rail, it's difficult for me to identify any new commodities that are coming in that could move by rail that don't already have a rail car design. If there were, it would really be centered around pretty niche commodities that I don't think would drive a lot of robust growth to overall rail traffic levels or to overall rail car demand. Where I see the real opportunity, it's not in specific rail car types. It's more in line with length of haul. And so when you look at modal shift between rail and trucking, I don't think this is new for many people, but trucking has been picking up share while rail has been losing. And when you look at the length of haul, you see that length of haul for both truck and rail are increasing. What that means is that trucking is taking more of that middle territory that has been competitive for both rail and truck. And so truck has been winning that battle more often than rail has. And so it's not so much a certain commodity or a car type that will be driving demand. It's more about making rail competitive at those more medium distance lengths of haul. And again, you're competing with truck in this environment. And so as far as commodities go, it's boxcars and intermodals that I think has the greatest opportunity for growth going forward.
Yeah, let me add to that. I would agree 100%, specifically on the intermodal side, just because of how inventories have changed since COVID, right? That has really blown everything up. So the whole concept of length of haul is really important because you have that first mile, last mile issue. And that has been a big topic since COVID hit, and trying to solve that problem, because everybody wants things delivered when they want it, how they want it, at any time that they want it. And so rail has to be part of that equation. And they are, but I think there has to be a more urgent type of understanding of what that means and what those changes mean. Are these structural changes that are permanent? Or did some of the things that we saw during COVID, are they a bit more temporary? And I think in general, we're seeing structural permanent changes in the buying behavior and how that works. So I would agree with you, Jeffrey, though. Not Jeffrey, sorry, Joseph, that in general, there really is no specific commodity that is going to be the one that kind of comes back. We're not going to have a frac sand type of market, that changed the dynamics quickly.
Thank you, Eric. Next question we received. Does the fleet utilization rate of 70% include intermodal cars?
Yes, it does. There's a couple things to consider there, just to make sure that it's clear. Even though intermodal units are roughly equal to intermodal carloads, the intermodal cars, they get much quicker turns and they have several units onto a single car. And so that's just important to understand with looking at utilization rates, is that even though units are the same, there are fewer cars because of how many units move on these cars, and they turn so much quicker. So even though they are included, they have a relatively small vote in the equation, just based on the nature of that commodity. But yes, that 70% number does include intermodal equipment.
Yeah, I think the number of the cars is what, 75,000. But the problem that you run into with, and it seems to fluctuate 75 to 100,000. But it's the thing is we actually are trying to measure the platforms and the slots. And so to what is being talked about there is we actually do have productivity measures that we look at so we can understand that. But on the totality, if we're looking at utilization, he is absolutely right. You're really looking at the cars and the way that they classify a car is, if it's an articulated car, let's say it's a 5-unit articulated car, for most of us, we would think of it as 5, right? For the railroads, they say it's 1 car. So to that extent, it's less of an impact in the total number.
That wraps up the questions we've received. Thank you again, Eric, Joseph, for the time and presentation today. For our attendees, if you have any questions you come up with, feel free to email them into us at info@rsiweb.org, and we can follow up to address those questions. Also, a reminder, our recording will be made available following today's presentation. So thank you again. Hope you all have a great day, and we'll see you again soon.
Thanks for having us.
Everyone.